IndusInd Bank has been rocked by big and small crises in the past 2 years, the latest being whistleblower allegations on procedural lapses in the microfinance book. While admitting to these lapses, the bank has prudently provided for the same in Q3 and committed to strengthening the processes. The overall pain at the bottom of the pyramid lending is also largely recognized and has been provided for. While the slowdown in MFI did impact the overall loan book growth, the bank is guiding to a strong growth highway ahead. Armed with a decent deposit book, competitive cost of funds and adequate capital, FY23 and beyond should see very strong earnings traction. Now seen in this light, the undemanding valuation provides headroom for further re-rating. Going by its internal review, procedural lapses were detected in MFI exposure to the tune of 186 crores and the bank has fully provided for the same. The bank's coverage on microfinance NPAs is at 95%. It does not expect MFI credit costs to go beyond the guided range of 6 to 8% of loans. The quality of the book ex-MFI is quite satisfactory. Net slippages for the quarter were at 0.9% of loans, lion's share from MFI. Net slippages from rest of it were contained at 0.3% of loans, while gross slippages for the quarter was similar to Q2 due to MFI. Thanks to higher write-off and sale to ARC, the overall asset quality improved with lower reported gross as well as net NPA. Provision cover on NPA stood at 72%. The bank also carries contingent provisions worth 3,328 crores. Total loan-related provisions are at 3.7% of loans or 144% of the GNPAs. The restructured book reduced sequentially from 3.6% to 3.3% of loans. Now, the bank expects normalization of credit cost in FY23. Thanks to the trouble in MFI, overall loan growth at 10% looks muted. Growth came on the back of corporate lending with subdued retail performance. In retail, however, vehicle as well as non-vehicle retail are showing signs of revival and MFI has huge potential once the crisis is convincingly behind. The bank has three strong pillars: vehicle, MFI and gems and jewelry, and expects all engines to fire in FY23. While FY22 might end with growth in early teens, growth in 20s is being targeted for FY23 and high teens in the foreseeable future. The good news is, although corporate lending was at the front seat, the quality of underwriting has improved as seen in the decline in the ratio of risk-weighted assets to total assets to 72% from 78% a year ago. Prudent lending was made possible due to the strength of liability. In fact, IndusInd sequentially improved its interest margin by 3 basis points to 4.1% despite a quarter-on-quarter reduction in lending yield on retail and corporate. This was possible due to decline in cost of funds. The steady decline in cost of funds along with high-yielding retail book spells good news for interest margins. Since the bank is sitting on surplus liquidity, courtesy deposit growth far outpacing credit growth, as the excess liquidity wanes, interest margin has room to expand. IndusInd has seen strong surge in deposits, 19% YOY, although there was a slight slowdown in Q3 as a deliberate strategy to shed high-cost deposits. Low-cost CASA grew much faster with CASA share stable at 42%. The bank has seen 68 basis points reduction in its cost of deposits in the past year. The only area of incremental focus should be to increase the retail share of deposits from existing 40% level. IndusInd's comfortable capital adequacy at 19.07% with CET1 ratio at 16.16% and stable deposit base prepares the ground for a strong growth post-COVID. Seen in this context, the valuation looks undemanding, leaving room for further re-rating. Of course, a key risk to watch out for will be COVID-19, possibly impacting earnings as well as asset quality.